Well, hello everyone and welcome to our December economic and RBA update. I'm joined here by my good friend and co-host Evan Lucas. We have a massive show to get through. We promised a big show to round out the end of the economic year, and we've got lots to do because last time we caught up, we skipped all of the European and overseas market updates.
We had things to do, like the Melbourne Cup.
So we had lots to do. Yeah, it was a holiday day. So we're gonna be going through quite a lot today. So strap in because it is going to be a show that we cover some serious ground right across that. Now we've obviously gone live around sort of 10 minutes out from the RBA announcement. Now there won't be big drum rolls in terms of what's going to be happening at 2:30 today because most people would understand effectively what's been going on, but there is still some interesting things that we want to see in the statement.
Yep.
We're literally going to scroll right down to the bottom of the statement to see if there's going to be any signalling to market.
I think the whole statement could be fascinating. I mean, normally we will do the comparison, from the November meeting to the December meeting. It may actually be completely pointless.
Yeah.
We were talking off air about
fresh statement.
Are we going to see what's referred to? I call it reverse jaw binding.
Yeah.
So do we actually? Because at the moment, we talk about the only lever that the RBA's got is the blunt sledgehammer tool that is interest rates, is sledgehammer during fine art, blah, blah, blah. We've said that many, many times. It's not about that. It's about, does it have to start laying the groundwork to actually slow us down? Now, this is the other thing I think, and we'll make the case constantly over the next hour and a half about won't they 2026, how they're going to deal with it. Is this 2015 through 17 where they didn't move interest rates in any direction for, I think it was 30 consecutive meetings?
Yes.
Because the next arsenal they've got is basically trying to communicate in a way that actually controls behaviour, and that's all they've got left now. So that may be what happens today, is why the statement may be even more of a transformative discussion, because it will be about the language that they use, how they use their language, because they know at the moment the consumer's the interesting one. We're going to go through that as well after this comes out, because the consumer is fascinating.
Oh, it's the only lever they've got left, and this is why we want to prosecute that today.
Yeah.
So what do we see in terms of since the November Cup Day rate call? We did have that, inflation spike, which spoilt the Christmas rate cut. So we got that data in late October. But we now are starting to see the fiscal policy and the government spending story being problematic. And we want to prosecute a bit of that argument with something that we saw from the chief economist at Westpac, Lucy Ellis, recently. So I'll talk to that in a minute. Obviously, it's this poor productivity story that remains still part of that key problem. So
where's that word gone?
Yeah, what happened to productivity?
Whatever happened to all the lead up to the productivity roundtable in August? That word has disappeared from people's lexicon. It's just didn't stop, right?
Well, we got our pay rises, mate. So what do I need to work harder if I get money in my back pocket?
It's going to be. This is not just about today's story. It's about what's happened in 2025, and we would point very clearly that the issues haven't disappeared, and so. What's happened in the last 6 weeks since we last spoke to you, I think is also the telling part of this discussion, is everything that had been bubbling along in the background all of a sudden just went bang and went, I'm here.
And what I liked about what Lucy Ellis tried to articulate in her update note on Monday, and remembering she's basically on her own in respect of her views around potentially 2 rate cuts next year, and so there is mixed views from different economic environments. So most of the other banks have moved towards rate hikes next year, but she is on her own. She's got a contrarian view. There's a word I can't say. So she's got that view in terms of that. So this is what she said in her note: higher inflation is policy-driven areas could force the RBA to keep market sector inflation below target, with negative implications on economic growth. Now, what she's talking about there, and when she's saying market sector, is what she's trying to prosecute here. She said most of the higher inflation is in the sectors that are insulated from monetary policy. Remember, RBA controls monetary policy and the governments control fiscal policy. She said that the RBA can still achieve its inflation target in this environment, so giving a little bit of sort of political room to maneuver there, but only by squeezing the market sector of the economy with tight policy to offset high administrative price inflation with sub-target inflation elsewhere. So this is what she's basically saying. So she wants to talk about unwinding the government rebates that drove electricity, which was a 37.1% increase since October of 2025. But she now is also talking about all governments. Local government rates rose by 6.2% over the year. Then we've got childcare, government education, postal, medical, hospital charges, aged care, anything to do with that, which is controlled really by government regulation and government control. And then we've got the tobacco debacle with a huge black market in tobacco. So now we just guess what we think inflation typically would have been because it's actually negative. And we'll see that when we get into the inflation data later. But given these price rises, inflation is largely concentrated in sectors that are driven by fiscal policy. So this is a little slap to the governments, basically not monetary policy. She said that for the RBA to be able to squeeze the market sector by offsetting higher inflation, price inflation, so she remarked that this was unsatisfactory in the way to run an economy. So we're getting this effectively less output because, we've talked about this on the pod and on these episodes before, that when the government is the buyer, inflation can run rampant. And that's exactly what we're seeing here as part of that. So the government does require
it's also
to
the
do
most
something.
Open she can now be now that she's actually outside the rather than an in. And like even Michelle Bullock in the last 6 weeks, in fact, it was last week, as close as I've seen her to say it, she basically pointed this out. She didn't say it to Canberra or even to the heads of states. It was globally, fiscal policy is running at such a high level at the moment that you've now got a scenario where it is probably leaving the neutral rate higher than expected. So she was talking about the fact that
well and truly
the 3.6% that we have at the moment, which is probably what we're about to see kicks in for the rest of 2025, may actually be under the way the fiscal's been run across the globe is the neutral rate, which in neutral rate, don't forget that is mean that it's not
expansionary or contractionary.
Yep. So that's the concern here. And that's what, Lucy now can say a lot more freely than she was in her previous role, which is that, the government spending that we are getting, the fiscal side is a stimulatory measure at the moment. It is in a much more explanatory level. The monetary policy side, therefore, can't come through and do what it needs to do. It's actually working. It's basically, the learner driver with the foot on the accelerator and the brake and just glazing them out. So,
but if you cast your mind back, say, 12 to 15 months ago, and even on this pod we talked about in terms of that neutral rate, the predictions of the neutral rate way back then, was 2.75.
Yeah.
2.75 was what all the economists were saying was going to be the neutral rate.
Some of them were even lower. Some of them had it at 2.5, and some of them had it down as 2.1.
So we were talking about 2025 having potentially 4 or 5 rate cuts during that cycle cutting, and we don't find ourselves there. And this is where Lucy, brings it home by saying there must be a better way to keep inflation under control than to keep the boot continuously on the neck of the Australian consumer. In other words, if government keep doing what they're doing, we're the ones that have to put our hands in our pocket and stop the inflationary story as part of that. I don't think we need to land it right on because I think we're going to know the answer.
I want to read the statement.
Yeah, well,
because that's going to come out.
We're going to get to that statement, sorry. So it really is just an important message here to say there has to be a better way. And ultimately, this is basically telling the government that some of your levers that you are pulling, including spending, but also in terms of your regulatory areas and what you're doing around giving wage increases when you're not getting any productive increases, so it's just money for nothing, has problems in our economy. And this is part of this, sort of landing that sort of.
It's unchanged. It's more about that is a very, very short statement. Like it is 1, 2, 3, 4, 5, 6, 7 numbers long. It is tiny in terms of what it is.
Keep it simple.
Like,
let's have a look. Let's bring it across and let's see what we're learning here. I'm just going straight to the decision. Recent data suggests that the risk to inflation has tilted to the upside, but it will take a little longer to assess the persistency of inflation pressure. So here's their little enough rope in terms of that. Private demand is recovering. Labour market continues to still appear a little tight, but further modest easing is expected. So unemployment is expected to rise. The board therefore judged that it was appropriate to remain cautious, updating its view of the outlook as the data evolves. So no jawboning, to your point there, in terms of the board will be attentive to the data and the evolving assessment of the outlook and the risk to guide this decision.
Read that last sentence.
In doing so, it will pay close attention to the developments in the global economy and financial markets, trends in the domestic demand and the outlook for inflation and the labour market. The board is focused on its mandate to deliver price stability and full employment, and will do what it considers necessary to achieve the outcome.
So that's the line.
Yep.
So that's the line, which is basically said.
Unanimous decision, by the way.
So yeah, that's obviously the new board set up where they have the vote.
Yes.
That's a line under 2025.
Yep.
That is them basically putting the ruler underneath and saying, thanks very much, we're done for this year. But we have now given you the last line to just go to Christmas time, which is, please be very, very aware.
Yep.
We are now going to go to a scenario where we are live both directions.
Yes.
And we are going to be live to give you that idea that if we need to move rates higher, we will do so, because the price stability is the core part.
And we're going to prosecute both sides of the conversation, because we did, and we're going to do that by looking at GDP, but also looking at some of the inflationary story in there as well. Now, there's a couple of slides that I'm going to go back to in our slide deck. The first one we want to talk to is this energy story, right? So what we saw in relation to energy, if I go to this slide here, you can see real household spending by component. You can see electricity, gas, and other fuels year on year, 20.6%. Now, if you look through all of the other year on year, and you're seeing which is outside the 2.5 to 3% targets, the only other one is recreation and culture that I can see. And then one, clothing and footwear, health and insurances and other financial services. So, and purchase of vehicles. So what we're seeing there is what are those, what inside this list here is government-led versus what is consumer-led. So purchase of vehicles, that's definitely consumer-led. In terms of the supply of electricity is government-led. Insurances and other financial services, that has been off the back of climate and claims and so forth. But health is very much in the government control. Clothing and footwear is very much in the consumer's control. Food is very much in terms of what we consume, other goods and services. But remember, clothing, footwear, other goods and services are all food. They are all underneath. Education services is surprisingly low, because I think there's going to be some
in the inflation figures. So this is the actual consumption on spending.
Correct.
Don't forget, before we go any further, we need to divide also what in my world, which is discretionary versus essential.
Yep.
So
good point.
The essentials have to shelter, transportation and energy, health, education.
Yep.
And then the other one there is the movement of people.
So now done. That makes a lot of sense to me in terms of educational service, only 1.6%, because obviously we locked out a lot of international students, and that has caused billions of dollars of reductions in terms of that. Now, the one we want to quickly look at is the energy story. So talk to us through this, Evan.
So this chart is directly lifted from the ABS. So the Australian Bureau of Statistics has been putting this chart out pretty much ever since a state government, not necessarily the federal government, but a state government put in some form of energy rebate. So we go back to June 23 to where we are now, the last read, which was November. And the 100 is the 0 point, right? So that's the snap.
Yep.
Above that is the percentage increase. Below that is the percentage decrease. So the one to really look at there is when point B, which is EBRF, which is the energy relief package from the feds, really cook in. It actually saw your prices drop by about 30%. And that's what you saw from Lucy Ellis talk about the fact that from October 24 to the peak.
When you combine some of the state and the federal initiatives during that time,
we have had a 37% increase to the peak. Now, as a government, that's a problem, because
Huge problem.
that's that is, as we just showed, the 20% of the household spending consumption part from GDP is on this.
Well, it cost us $11 billion to facilitate that sort of, because it's still our money that we have to pay, right? Like,
but the bigger catch is the fact that that dark blue line sooner or later has to catch the light blue line.
Yeah.
Because what the top one is showing is that without all of the rebates since June 23 to today, the energy prices would be up 21.7%. We haven't got back to that yet. So at the moment, with the last one we've just had, so that's $75 per quarter, we've been getting. We've now officially been told. Now, my EFO, when we're recording this, is actually early next week.
Yes, it is.
But we have been told by the Treasurer it is done.
Yep.
We are going to, in 2026, have to gap up to that.
Correct. So that's where, again, we'll continue to look at core inflation as opposed to the spikes from energy and these types of areas.
That is absolutely core to what we've just seen, which is, don't forget, this is not in the RBA's remit for moving rates because it's not core. It sits outside it because it is highly volatile. What it does filter into, which is core, transportation.
Oh, everything.
Movement of other goods.
Everything. So it's the biggest input
it'll
cost.
Come later. That's the catch.
We've been saying this for years, that energy is the most vital thing in a thriving economy. Cheap energy runs the world, and especially as we're moving to an agentic world with AI, energy is going to be the biggest talking point. And so we don't care how we get there.
No.
We want it cheap and we want it reliable. And so any government that can get off their bums and provide that for us, mix of renewables, gas, nuclear, the whole, just make it happen, because you are going to stifle your economy and you will be left behind in the world of AI if you don't get off our backsides and do something about that. Anyway, enough of my mini rant just then. Let's now turn our attentions to GDP. We will come back to it. So our quarterly GDP number, we saw that drop on the 3rd of December. Now, this is obviously for the third quarter, so this is the end of September. And our economy expanded by 0.4 of 1% in Q3, following an upwardly revised reading in estimates of a 0.7 for Q2. Now, that's the 16th consecutive quarter of growth. Household consumption slowed sharply, 0.5 versus 0.9 in Q2, as discretionary spending cooled. Now, it has heated up, because remember, this is lag data for Q3 as part of that. Government spending growth was little changed at 0.8 versus 0.9 in Q2 versus Q3. Net trade was a drag, while exports 1% versus 2.3%, rising less than imports, 1.5 versus 2.3, whilst inventories subtracted to 0.5 of 1 percentage point. In contrast, private investment surged 2.9% versus 0.2, contributing 0.5 and making the fastest pace since Q1 of 2021. This is important. Moving away from government spending and into private spending is going to be really, really important. Now, when you strip back that number of 2.9%, because it's a big number, hence it's the biggest number since Q1 of 2021, so almost 5 years of data there. What we see there is a huge arrival of aircrafts, new planes arriving into our aviation market there. So I'm curious about that in terms of what's happening. And when we get to household spending, I'm also curious about how Black Friday has played into that particular story. So have we seen basically Black Friday, which effectively started in October this year versus November, in terms of what's happening? So public investment also rebounded 3% versus negative 3.5 on the back of renewable energies, water, telecommunication, and rail transport projects. Net household saving ratios also increased 6.4 versus 6. So not a bad quarter. Not a bad quarter of data, tracking in the right direction. What did that mean for our annual growth? What we saw is the annual growth in Australia increased to 2.2% following a 2% rise in Q2. So we did say, 2.1%, my bad. So below the forecast of 2.2. Now, when we think about our annual growth rate in Australia, that's averaged 3.32% since 1960 to 2025. That's a pretty okay number, but it's not where we used to be. But this is where the great debate is about all of the throttles, the regulation, all of the infrastructure that we currently have in play. This is where a debate's going on with economists about whether we're at peak supply and we can't meet the peak demand, and that's why we're getting inflation in the economy.
Yeah, and it was, again, where it came from. So the figures before showed that the 20% of the household consumption number was around energy fuels. If you look at where the total figure of consumption was in the overall diversification basket, it was 52% of total spent. Now, historically, it's actually higher. It's actually 58. So there is push-pulls to this without public spending, which is falling. I will give it that credit. It is falling and falling quite quickly. Without it, we would be in trouble. And so that's
that's the debate. That is the debate around problem here. Full employment. So this is this sort of thread the needle approach that the government was trying to do. So there are definitely pros and cons. If we had just tightened up fiscal and had a harder landing, we'd be out the other side of this by now. But there could have been more damage, which is Evan's point, to the broader economy.
It's not even about that. Like for me at the moment, the caveat is, as you point out, I agree with you, which is there is still no runway, or at least any sort of breathing space for private investment to come in.
No.
And there's no incentive. I mean, I sit here and talk about this all the time. It's not just the feds that we need to be highlighting, it's the states, right? So the change at the moment, one of the biggest discussion points for 2026 will be how uncompetitive, particularly the East Coast states are, with things like payroll tax. Right? Like, why would you have a tax that actually restricts
the number of people you employ
that you have? Or why would you also have a policy that, we're in Victoria, it's 6.75% once you hit $1 million in turnover. Like, what a disincentive to do what you do. So this problem is why I'm going to come back to my biggest bugbear for 2025, which has been productivity. And these regulations around what we need to do to get forward. It's not that it's rocket science. Again, the other catch is, as Ben's just been pointing out to you, is that if you were to change payroll tax, let's take that as the example, the state governments wouldn't be able to spend like they are, and therefore do the infrastructure spending that they're doing. But again, we need those people that have got sucked into the public sector to get sucked back out of it.
Correct.
And so
why we also need a consumption tax.
So this is why this is fantastic, in the fact that, look, it's good to see that per capita GDP is finally moving away from those 7 consecutive negative quarters that you and I were talking about when we first started doing this together, that also we're now away from that. But as you can see, it is still a long way off the averages of 2010 up to where we are now. And realistically, the one that we need to be targeting, which was during the 90s and early 2000s.
It's almost 5 times off where it should be in historical terms of what it looks like. And then if we go and have a look at the
favorites,
which is per capita, we are still in a recession per capita when it comes to the long-term movements of our GDP. So this is about how we feel. Do I feel better off under the current settings of
And that's the term. Right? Feel.
Do I feel better off? And the reality is a lot of people don't feel better off because we don't have that economic dynamism that we need to move forward. And that's all off the back of the government policies, the government regulations, and what's happening. Now, there is one positive story here, and that is that some of the spending has been on infrastructure. And that infrastructure is going to be key to productivity movements in the future. It's what we paid for that infrastructure in terms of the overrun costs and the economic return that we get on that money, considering in Victoria's case, we're going into almost $200 billion of debt to get that public infrastructure. So we're going to be paying for it 2, maybe 3, maybe 4 times over. And that's why we need all of these higher taxes and charges. And that starts to get me really angry. So I'm going to move on.
Well, the cash will be in the future. Does it go through taxes and rates, or do they sell it off, recuperate the debt, and then we get charged as the private investor?
Well, that's right. I mean, at the end of the day, we're still going to be. So get ready for more toll roads. Get ready for all of those types of things. Now, here's the annual inflation story. So we wanted to go a little bit deeper on this annual inflation story. So we'll start with a big number here. So annual inflation rose by 3.8%. So this was the shock number at the end of October from September, and that aligned with above market expectations of 3.6. Now, the RBA did signal that we were going to have a little bit of a bounce when it came to this, but it's certainly outside of their 2 to 3% target. In the RBA's first, or the ABS, I should say, first full monthly CPI read released, and it's going to take about 18 months for this to sort of settle itself down. Electricity prices accelerated at 37.1%. versus 33.9% in September after the expiry of some of those government rebates that we talked about there. Food inflation stayed elevated at 3.2%. And then we saw prices also continue to increase for alcohol and tobacco, although that was a bit of a guess because they don't really know what tobacco costs are these days because it's all on the black market. 4.4% versus 5.5%. Clothing was 5.4% versus 3.8%, so a bit of a spike on spending and clothing. Furnishing, 2.1% versus 1.8%. Health, 4% versus 4.2%. Transport, 2.7% versus 2.3%. Communications, 0.8% versus 1.6%. Recreation, 3.2% versus 1.8%. Education, 5.4% versus a flat rate of 5.4% last month. And financial services, 2.2% versus a similar reading in the month before. Now, the trim mean also rose year on year to 3.3%. That's the one that we were looking at. But let's move into a breakdown of that data because this is what we were talking before about. That's what we saw in household spending and where electricity was the signature. But this is where we get into it in terms of, and this is what Lucy Ellis's and our argument has been around, what is it that we can control as consumers? So when we start to look at this, we start to say, okay, well, food and alcoholic beverage, some of them essential, some of them are discretionary. But look at the housing number in there, Evan, if you want to talk to that.
Yeah, so just to take you through this chart, this is, as it says, the all groups of the inflation basket that we're now going to get every month.
Yep.
But it also tells you the weight that it has inside the basket. So the one to highlight, as you said straight away, is housing. It's over a fifth of the total basket and a movement of 5.9%. That means that 3.8, 2.15, or as you can see, the 2.485 percentage points was down to housing. Now, don't forget, housing is not the price increase. That is new construction and rent. And you and I have been harping on rent for at least the last 6 months.
And look, I mean, I'm in the Herald. There was a national sort of story on how rents are going to increase over the next decade. And I came out as the chair of PICA and I said, yes, rents, we're telling our members to increase your rents by 4 to 5% currently per annum off the back of all of the government regulation. So if you keep making it cost more to run our businesses, minimum standards, the insurance costs, all of those things add up in terms of running your small private rental accommodation business. So we're not profiteering at the moment. We're actually cost recovering. And so this is a perfect example of where government interference in the marketplace is causing this inflation. And obviously we know in health, when governments are the buyers, it always runs pretty hot. Transportation, there's a mix in there in terms of what government can control and what they can't control.
So the two to highlight exactly with Ben's point is health and education, right? So health historically has run at about 4.1% for the last 20 years. Now you just have to do that on an accumulation calculation and what that actually means, and explains why at the moment health pricing is out of control. Education also is at 4%, now at 5.4%.
Yep.
That is actually down to several changes that state governments have made.
Correct. It's payroll tax.
Payroll taxes.
Payroll tax being it. So here's the state government making the job very hard for the federal and also the RBA board to get inflation under control.
So looking at all that, when you look at this is why the RBA has just today, as I said, run the ruler underneath 2025 with that statement. But that last line is saying, we now need the dynamism to move. The catch is this, and what they're also saying is that if we look at housing, let's take that and really put the spotlight on housing. We know that government regulation has led to a reasonable increase in rental costs and therefore price increasing over the last 3 years. Okay, rates have come down 75 basis points, which is not offsetting any of that realistic cost. If they are to increase rates next year, along with the additional rental requirements that are known to come in 2026, then there is no doubt that increased movement of inflation in housing is only going to stay where it is.
Correct.
It's not going to roll off. So if you've got a fifth of your basket being impacted by both monetary policy and fiscal policy, then we're not going to get to the inflation figure.
And also, let's not just pick on the landlord. The other key component of that is the new build costs. Well, look at all the regulations in new build. I mean, it just takes forever to get through all your permits and all of those. Those come at a cost. The longer that you hold the land comes at a cost. So everything starts to come at a cost. So what are we saying about having regulation reform and moving all of that red tape out of the system so we can get more supply.
Okay, so here's the debate on that one. We've just spent, what, $7.4 billion on energy rebates?
Yes.
Right. So intervention is what that is. The argument now is, what if we put $7.4 billion intervention into the goods of housing? So if we were to reduce the lumber costs,
yes,
the concrete costs,
you get a bit return on your money, wouldn't you?
Right.
You have to, because of the weighted average in terms of the
how much more production of housing would that have led to?
Have to be meaningful,
right?
Have to be meaningful.
So if you've put supply into the market by intervening, which I don't agree with, but the $7.4 billion of reducing good supply would then go to that housing figure about how much more rental properties would actually be into the market at this point in the cycle.
That's
from
right.
July 23, when we started these energy rebates.
Yeah. Because that goes
theoretical rubbish.
That goes into the core. I love the debate.
Somebody asked me this the other day.
The thesis is good, right? Because this is still core inflation here, whereas as opposed, that's why they ship energy out, because that's the problem. But
and you said before, feel good, right? The government has a problem. It needs its electorate to feel good and make sure that although your living standards are sliding, let's not beat around the bush, it has been a lesser impact in the fact you've had some money to keep doing the things you like doing, rather than some hard-nosed edge.
But let's also be creative as politicians to meet the housing crisis, and let's offer a 5% deposit guarantee, and let's spike demand, which will obviously then push into wage inflation.
Show's too long, mate. Let's keep going.
All right, let's move on. But you can see what's going on here.
Far out.
I mean,
there's my rant.
It's been it hasn't been by chance. It's been by politics and by setting priorities in the wrong order. Anyway, here we go. In terms of unemployment and the participation rate, we saw seasonally adjusted the unemployment rate decline to 4.3% in October from September's near four-year high of 4.5%, compared with market expectations of 4.4%. The number of unemployed people fell to 17,000 to 665,400 in October, down from 682,400 in September, which was the highest level since October of 2021. Now, remember, the RBA just said they expect unemployment to creep up higher. Among them, the number of people seeking part-time jobs fell 4,600, and then those looking for full-time work declined by 12,200. Meanwhile, employment increased by 42,200 to a record high of 14.68 million. This is the positive story of the economy, is the number of people employed. That's why we haven't bottomed out as much as we'd expected, but that's the consumer consumption piece that's also now, people opening their wallets, thinking that rates are done and inflation's been beaten, and now we've got this spike in terms of that. So we saw that was, that 42,200 increase in employment beat the forecast of 20,000. So there was still a lot of heat in the economy, and that's the debate around demand or capacity in the economy to be able to meet that. And so there's got to be an argument there in terms of some spare capacity in terms of human capital, but other ways in which we can find productivity through innovation and technology and so forth. Participation rate remains unchanged at 67% even, and then the underemployment rate fell to 5.7 versus 5.9. So we are seeing a pretty healthy employment market, and that's leading into, from a consumer point of view, they've also been pretty positive in that particular space. Now, I want to talk about the wage price index. We haven't gone here for a little while, and we said this was going to be a mega show, and we weren't lying. In terms of the seasonally adjusted wage price index, rose by 4.3% year on year in Q3, unchanged from the previous quarter and in line with market expectations. Public sector, i.e. government jobs, wages increased by 3.8% across the board, slightly above the 3.7% rise in Q2. So Q2, 3.7, Q3, 3.8, while private sector growth was 3.2%, easing down from 3.4. So the private sector is doing what it can to try and manage productivity, inflation, and so forth. The public sector, and this is where the government say, we've increased wages for everyone. That's good, but it's inflationary. So just remember that. No, so in original terms, so we've got electricity, gas, water, and waste services industry and public administration recorded the strongest growth in wage gains of 4.3% each, They were followed by healthcare and social assistance, 3.8, mining, 3.6, education and training, 3.6, construction, 3.4, rental, hiring and real estate services, 3.3, and professional science and technology services, 3.3%. So I cannot, this agenda of regulating the crap out of everything just costs productivity. It costs movement, and we can still see it. And we think we're doing, well-meaning people think we're helping those less fortunate in our community. But every time we put more and more regulation into the system, it delivers a negative impact to productivity prospects and also increases the cost burden in terms of being able to administer all of that additional compliance. Healthcare and social assistant roles were the main contributors to the quarterly wage growth. On a quarterly basis, overall wage prices rose by 0.81%, matching the previous quarter and aligning with market forecast. But this is a story, people, where we've got to get this these wages under control until such time as, what Evan points out, productivity, people, let's lift the productivity. Okay, let's move that on in terms of consumer sentiment. What do we see in the consumer sentiment data, Evan? Look at this number here in November, 103.8. Where did that come from?
Yeah, and I actually got to interview Matt Hassan on Money News for this, and he himself was like, we were very, very surprised by the figure because it actually straddled the lead up to and then post the RBA meeting in November, which made, for pretty sober reading, as you and I went through.
We were commenting that this would fall, this would nosedive.
And he was saying the same thing.
Completely wrong.
The fact that we couldn't get there, particularly at the end of September, where we had just had the suggestion that another rate cut was coming and what have you.
Yeah.
Everything in the momentum was moving that way, and we didn't. What fascinates me by this chart is the fact that the family finances for the next 12 months, that's really optimistic. It's just under 110. Yeah. And the fact that the outlook for the next 5 years is also quite robust. Considering if you look on the left-hand side, the average, we're normally quite pessimistic about the next 5 years.
Yeah.
Now, maybe that's because coming from a low base has been a tough period. We are coming out of the full-blown cost of living crisis, not over, but the full-blown scenario of it could explain that away. And that's what he talked about there. Again, the other thing to look at here is the unemployment index we are so bullish on that. Not surprising considering, as you just showed, the employment market's tight. The probability, therefore, that you feel like you can get a new job is pretty high. No wonder we're fairly optimistic about it.
Yep.
Also explains why we are able to go, okay, things are tight. Inflation's a problem. Maybe I'm not getting my rate cut, but my job's pretty secure. If I really wanted to, I could go and negotiate a better one. Like that, that very common feeling, because that's what this is. This is a sentiment.
Yep.
Is why we are doing things that traditionally, in a scenario that we are feeling in the reality world, would be a different action.
Okay, so here is the really important. On the 15th of December, the December data for November comes out, right? So we're going to see some interesting data there, because what it did say is a lot more optimism from those people outside of the mortgage belt. But the mortgage belt were the notable exception in this particular data set. But obviously, because everyone else was so much more positive, it didn't flow through in that data. So do we expect that the December number will pop down?
Yep.
Potentially. We would.
The final thing, I agree with you. The final thing to point out there is that time to buy a major household item, 31% year-on-year increase.
Yeah.
They're also pointing out the lining up with Black Fridays.
Yeah.
So the lineup for Black Friday is that it was actually slightly earlier this year than last year. And that also when's the survey happened. Yeah. So there are ways to explain away what is clearly some outliers.
Could be a blip. We'll see what happens, but that data really is important, because it's next week, and it's going to lead us into how optimistic and how open our wallets are going to be over Christmas, because that's going to be quite an interesting thing, which leads us into household spending. If we're feeling good, we get out there and we spend, and that's exactly what happened during the last release. So we did see that the household spending in Australia grew by 1.3% month on month in October, picking up from an upwardly revised 0.3. Now, remember, we did mention that the end of October saw those Black Friday sales kick in. So that really it marked the strongest pace since January of 2024 amid improving consumer mood and early holiday-related purchases. Expenditures rebounded for alcoholic beverages, 1.8% versus negative 0.6%. transport, and hotels and restaurants. Additionally, spending growth accelerated for food, furnishings, and miscellaneous items. Meanwhile, spending slowed for health, recreation, geographical New South Wales, 1.6 versus Queensland, 1.5, Australian Capital Territory, negative 2.4. That joints a social democracy and failing. In terms of Victoria, only 1.1. We're going in that same direction. Western Australia, 1.1. South Australia, 0.9 of 1%. Posted gains, whilst the edge down in Tassie, which was negative 0.1 of 1%. On an annualised basis, household spending rose 5.6% faster than September's 5.1%, and points to the steepest growth since September of 2023. So we're spending, people, but I reckon again this data is sort of post data. So it's I think there's going to be a change.
Bought forward data.
Yeah.
Like, again, this is what the RBA and what the Bureau of Statistics is talking about with the changes around just how much the embracing of Black Friday has been, that it is actually now distorting things. So I agree with you. Like they pointed out, the amount of money through the system for Black Friday is a record. It has overtaken in physical value the post-Christmas sales, which in itself is saying something.
Okay, so let's move our attention now to the big end of town and the business spending. We saw the NAB Business Confidence Index edge down to 6 in October from 7 in the previous month, though it remained above its long-term average. Meanwhile, business conditions improved slightly, 9 versus 8 in September, supported by stronger sales. So that's what's happening here, 19 versus 14. Profitability, 9 versus 6, been profitable time. Employment remained unchanged at 3. Simultaneously, price pressures eased, with purchase costs rising at a quarterly rate of 1% and labour costs of 1.5. So there's that cost coming through. Capacity utilisation rate also inched up to 83.4 from 83.3, indicating activity levels remain high. The chief economist, Sally Ould, said that continued strength in business conditions shows the economy has maintained the momentum built in late 2024. However, she noted that the growth is occurring amid limited spare capacity, with high utilisation and persistent wage and margin pressures still weighing on confidence. Okay, so if we take a look now, pivot towards the property story here, in terms of we all saw what's happened. I'll round out the year numbers. So annual growth up until November 30, we saw Sydney at 5.1, Melbourne at 4.2, Brisbane having a strong year at 12.8, Adelaide 8.2, Perth a very strong year at 13.1, Hobart 4.7, Darwin the number one performing capital city in Australia at 17%, and Canberra 4.2. Regional markets also outperformed the capital city markets at 8.6 versus 7.1 overall. Now, what I wanted to show as we round out the Australian data is the peak to trough. So who's in peak of their cycle? So Sydney's currently in peak of cycle. Melbourne's just shy of peak of cycle. Brisbane's in peak of cycle. Adelaide's in peak of cycle. Perth's in peak of cycle. Hobart is negative almost 7%, and their peak of cycle was way back in March of 2022, the same as Melbourne. Darwin's now at peak, and Canberra is also negative 2.4% from its peak in May of 2022. Regional New South Wales is at peak. Regional Victoria is still negative almost 3% from its peak in May of 2022. Regional Queensland at peak. Regional South Australia at peak. Regional Western Australia at peak. Regional Tasmania at peak. And Northern Territory is NT is negative 8.8, almost 9%. And it hasn't recovered from that peak, which was April of 2016, so a long time ago. So really, there's only 2 other regional markets in the NT, and that's Alice and also Catherine would form part of that market. So very small markets. So let's wrap up the Aussie markets and the property market. So what we learned from, we've been sort of threading the needle in this strategy in terms of a soft landing on the plane. Well, we've bounced a little bit on the tarmac with inflation. So we're the RBA is basically saying, let's do a wait and see. They're still going to be data-led, so they're not in the camp of rate increases or rate decreases at this point in time. But I suspect some of the signalling, depending on how the monthly data now starts rolling in December and January, will inform that decision when we get our next RBA update in February. Fiscal policy, we're hopefully that Jim Chalmers is listening to our messaging here that we have to start spending less, and all of the state governments need to start spending less. It's problematic, fingers crossed. Consumer is going to be responsible for the next rate move. What we mean by that, when we were talking about this earlier, is at the end of the day, if the governments keep spending like drunken soldiers, then inflation's still going to be around, and there's only so much that the consumer can determine in that. So if the consumer keeps spending also at a reasonable clip and inflation remains persistent, guess what? We're going to see interest rates go up, because if that government spending still got a bit to roll through the program. In terms of property markets, price growth remains favourable. So we would expect to see some further continued price growth with demand and supply out of equilibrium, but potentially not as favourable as the conditions that we've seen in Queensland, Western Australia and other markets. So still potentially strong growth in some markets more than others, and we've always taught you about that in terms of there are always markets with the markets around Australia. Okay, so let's now move to the United States and do an update on the US. Okay, turning our attention to the US market, what are our talking points for the US market? Tomorrow their time, we will see potentially a 25 basis points cut by the Fed. The pressure is on them. And so we've talked about a two-tier economy, and that is effectively the AI/technology-led transformation and boom that's happening over there, and that's relating into the equity markets, versus the rest of the economy, which is a little bit sort of sluggish, and we're going to see that in some of the data. In terms of what the decision around that cut, what does it do in terms of pushing inflation in each direction? We've got a debate on that. And then also the trade deal with the and China, US-China, is still an important part of what's potentially going to happen around the global growth story for that. So that's how we read the Trump experiment in terms of the businessman being in the White House. Let's move into looking at the inflation data. Now, caveat on some of this data is that the government was shut down for over 60 days. So we're still playing catch up in terms of getting a lot of this data. So I'll just quickly recap in terms of US consumer price rose by 0.3% in September. That's how old the data is, easing slightly from the August 0.4, but it certainly was below expectations of a 0.4. Now, we're waiting for obviously the October data and the November data, which is due out on the 18th of December, which is next week. So that'll be an interesting data point to have a look at.
Yep.
In terms of annual inflation, so we did see, no data coming through, but you can see from the slide that we're showing here of those listening in audio, we're seeing it move from sort of 2.3 in April to 2.4 in May to 2.7 in June to 2.9 in August and the 3% in September. So inflation is definitely coming back into system, and so it'd be interesting to see what happens there.
Which is why it's interesting that Thursday morning for us here in Australia is seen as a pretty much a decent log.
Yeah.
Because it's based on other factors, which we're about to come to. But you can't deny the inflation story in the States is a headache, and it's only going to be more and more of a really large standout in next year.
Well, if they supercharge the cost of money, that's the big debate in terms of will they be able to control inflation if they're going to make the cost of money cheaper over there.
Because as you can see from this is the federal funds rate. It's going to be interesting to where we are and have been going, and what they now have in their arsenal is that they are getting to that neutral equilibrium point. And again, you've been across the States, and I'm sure most of you out there.
Yeah, a couple of times in the last couple of years.
Depending where you are in the country, is a vastly different experience.
Things are tough in some markets,
and it's the most fragmented I've seen the States in decades.
And that's created this sharp divergence in the views of the current board at their December meeting, where it's going to be fascinating in terms of how many votes went each way in terms of a downward movement, because there's the rumours, the markets are pricing in 100% cut, and so that's what we talked about earlier in the December meeting. But there are a number of participants who judge that additional rate cut in December could be suitable for the economy evolving broadly as expected over the intermeeting period. Now, the economy also evolved broadly as expected, and then there are others who are suggesting that their outlook is keeping the target range unchanged, and they still think that they need to get on top of this inflation story. So let's go to the unemployment story here that we were seeing. We saw the US unemployment rate, and again, sort of some lag data here from September, 4.4% versus 4.3%, exceeding market expectations. So the number of unemployed people rose by 219,000 to 7.6 million, whilst the number of employed people increased by 251. So that was a 251,000. That's a good data print. That was something that surprised a few, but it's quite old. It's old. So yeah, so we just want to see what the new data is in terms of bringing it through. Looking at consumer sentiment, and again, if you're watching, you can see clearly the trend in the graph as we expanded that graph out over a period of 5 years. You can really see that the consumer is less optimistic than ever, and in terms of their confidence. So we saw the University of Michigan Consumer Index rose to 53.3 in December from 51 from the previous month, which was the second lowest result on record, coming ahead of the market expectations of a 52 reading, according to those preliminary estimates. It was also the first improvement in the headline index in 5 months. So it's been down from a reading in the 60s in sort of that June, July period. And we've been basically moving down further from that particular story. And what has that resulted in retail sales? Well, we can see here again, from going from reasonably optimistic after the tariffs weren't going to be as big as expected, the art of the deal, so to speak. But the economy, the consumer economy is starting to falter. And we can see that in the data where retail sales in the US went up by only 0.2 month over month in September. It is still lag data, but it's the smallest increase in 4 months following a 0.6 rise in August and below forecast of a 0.4% gain. So it was 50% below their forecast. Sales rose in certain areas, miscellaneous retail stores and so forth. But on the other hand, sales fell in sporting goods, hobbies, musical instruments, bookstores, clothing, non-retail. So it's definitely a mixed economy there.
And there's an argument that this is actually the movements from the start of the year. So the Liberation Day tariffs, all of that inventory, all of that numbers that have been washing through the June, July, August figures have now come out. So now you're actually starting to get all of that front-loaded movement come out. And that's why it's also showing up in the confidence numbers, showing up in the spending numbers, showing up in the overall, that everything that was done at front-loading from the April movement is now here. So the can that's been kicked, we're now standing on.
Well, but this is why I suspect why those who at the board meeting are saying, look at the momentum in the economy. We need to give it a little bit of a kickstart. And that's the argument, isn't it? Right. So despite the fact that inflation's at 3%,
yes, again, old data, this is the argument that we need to actually stimulate, because the forward-looking guidance numbers, which is this stuff, is saying that actually to start next year, we could fall backwards.
Yeah. So we just had a look at the consumer confidence. Now we're looking at the business confidence for those on audio, and the IMS manufacturing PMI in the US fell to 48.2 in November, the lowest in 4 months compared to 48.7 in September, and below forecast 48.6. The reading showed the manufacturing sector contracted for the 9th consecutive month and the least fastest. So they do need to inject some stimulus into the economy. And so a 25 basis points cut just might be that medicine that they need in terms of getting the broader economy moving a bit stronger in the US outside of the spend that we're seeing in AI and on energy and data centers. So let's wrap up the US economy. 2025, we see a two-tier economy. The businessmen are in the White House is the point we were making before. So let's see, in terms of all that investment and all their big talking sales of all the international investment rolling into America actually delivers. We've got a debate going on in terms of there's a bit of a Christmas rally that started a little bit earlier. I think it will be spiked on by a rate cut. So we'll probably expect another successful.
Or if they don't
rally.
do it.
Oh, yeah, we may. Yeah.
The bag of coal might be there, and therefore the Grinch is here. So the Santa Claus rally in the States is on.
Yes.
And unfortunately, the divergence between us and the States is getting slightly larger by the day. But yeah, again, it all does caveat on what happens for us here on Thursday morning. if they, or even if they do it and then say that's probably it.
Yeah.
I think that's the other part of the argument.
And whether you like it or not, for those people who are playing along at home and think that America is a basket case compared to Australia, there are several metrics that you probably want to measure yourself on in terms of an economy the size that they are and the growth that they can squeeze out compared to a controlled economy like ours. Also, their IR, their industrial regulation laws, like them or not, just have a look at their productivity numbers. So where you've got a less regulated and you've got a more dynamic economy, you actually get a greater lift in terms of the opportunity to aspire to have a very comfortable living over in the US. And so we do know that they absolutely pants us on our productivity numbers here compared to the Australian numbers as well. So that's what we're sort of debating internally in terms of the discussion around, will that productivity continue to kick on off the back of AI and agentic agents? And that will be the trigger for reducing inflation, or will the tariffs continue on? And also, will the energy story, because it's going to cost energy, if all of these data centers are rich in energy or hungry for energy, is that going to put energy prices higher? And that's going to cause more pain for middle class America. So that is going to be an interesting story in terms of how that plays out as well. All right, let's now move to China. Just a couple more to go. We're doing okay. We will probably go over the hour mark, but that's because we did promise to go a little bit deeper on our international markets. So let's bring home the China story here. We saw the inflation data. Well, again, whether you believe this number or not, they increased their inflation. They had a small amount of inflation, so there's not stagflation going on there supposedly. So 0.2 of 1%. In their October numbers, and that was defying expectations of no change. So a little bit of a heartbeat there. In terms of the cash rate, there's really nothing to see here. The PBOC kept the key lending rates at record lows for the sixth consecutive time in the November meeting, and that was in line with market expectations. Their next rate call is on the 20th of December, so there's still a little bit of news to be had in terms of what's going on in that particular market. The unemployment story, you can see there, and that's still hovering in that sort of 5 to 5.4 range. So the surveys that came out, this survey was dated the 14th of November for the October, and we saw that the urban unemployment rate fell to 5.1% in October, beating market expectations that it would hold steady in September at 5.2. That marks the lowest reading in 4 months. So there is a bit of an improving story in terms of unemployment. And that's off the back of, they are doing very well at moving their exports into other markets.
That's what we said.
The problem is their consumer.
Yeah. So we talked about the fact that there was a complete strike across the Pacific.
Yeah.
So 30% of shipments weren't just holding; they were completely cancelled.
Yeah.
When all the liberation tariff.
Yep.
China has always been very good at going, okay, we'll find other markets.
Pivots. And or ways to get their goods into the US via other markets.
And this is where they get accused of dumping.
That's
exactly what you're talking about. Yeah. But they do find a way. And that's why the interesting thing about the China-US scenario is we are still clearly no clearer on a deal.
Yep.
By the end of the year, I can't see by the 31st of December that there will be an agreement with the administration around what the tariff figure will end up being. Mm-hmm. Because Beijing at the moment is just going, okay, we'll find another way.
And they've got a demographic problem. We know that their population is in decline now over, so they've hit peak in population. But here's the other story here. This is the one that we wanted to just show for those people who are listening. There is just a complete collapse in respect of optimism versus pessimism off the back of the COVID recovery that other countries potentially went through. And so it's just chalk and cheese in terms of where they haven't been able to recover to an optimistic mindset inside China. And I think that was the trigger. I mean, we knew that the property market was frothy in terms of what was happening in the 2020s and, in that early part there. So the collapse of that property market with households having a lot of debt and not as much disposable income has caused major problems in terms of, and that's why, again, touching the property market and administering, price movement in property market is very dangerous. Yeah, it's one of those too big to fail markets. And you can see it here in that particular data as well, in terms of consumers' confidence in China increased to 80 9.6 points in September from 89.2 in August. But consumer confidence in China has averaged 108.82. So for those people on audio, that gives you an idea in terms of just how far away they are from their long-term average in that particular space. Retail sales, and this is what we were saying before, anemic growth. We saw it only increased by 0.16% in the October data. So really sluggish consumer spending, and that's causing problems over there. In terms of business confidence, the long-term trend, we can see also this in the chart, that anything above 50 is expansionary when it comes to the NBS manufacturing PMI index. And so we did see a reading of 49.2 in November from the 6-month low of 49, matching those market expectations. But it marked the 8th straight month of decline in factory activity. So I reckon they want to start getting a deal with America, which was one of their bigger trading markets, but no longer anymore. Let's talk about the key takeaways. So, outside of the US exports, China exports have been quite healthy. It's all their domestic economy that's struggling. And so we need to see what happens in terms of, to your point, Evan, that the US-China trade deal still seems up in the air.
It's just up in the air. There is no... Normally by now you get leaked information.
Yeah.
That there will be a deal. You get, those snippets. There is just nothing.
Let's see what happens when they meet. Let's see what happens with their planned meeting. I'm trying to remember, is that in the end of this? Or
end of the next week.
Or is it just before Christmas? Or
I thought it was just before. But either way, again.
That's going to be an important catch-up. Important fight. Both of them want to have some positive announcements back to their own constituents from their respective countries. Okay, let's bring it home now with the Eurozone and summarising their economic story over the last few months. What do we see? We did get a quarterly GDP data release. That came out on the 5th of December. And so what we see here is the Eurozone GDP growth grew for the third quarter of 2025 and revised slightly higher at 0.3 of 1%, up from the preliminary estimates of a 0.2 and above previous quarter of a 0.1% expansion. So we did see effectively that we are in positive territory. We are scratching out small amounts of growth, but talk about a country that's a group of countries that are paralyzed by bureaucracy and administration. You're looking at this perfect example of what it looks like, and that is what we see here in terms of the GDP numbers there. In terms of the annual GDP, this is probably where, again, their capacity in their economy can get to maybe 2% if it's really thumping ahead. It got to 1.2% over that time. So, that's scratched out, 1.4%, I should say, year on year for the third quarter compared to a 1.6% expansion in Q2 over that time as well. Then we look at the annual inflation story here, and we can see that inflation has picked up from the low that we saw in May at 1.9, moved through, the 2 was their perfect sweet spot in terms of what the ECB are trying to set it at. September 2.2 reading, October 2.1, November 2.2. Evan, are you seeing any worrying in this number yet?
No, I think more the point is, and you're about to bring it up, is that they have moved their lending rates, the three baskets, to fix that May number. What they've been happy with is that they haven't caused a spike in inflation. What they won't be happy about is that it hasn't led to any sort of meaningful change in output, and that's what you were showing before with GDP. Nothing gets me concerned yet, but if you listen to Christine Lagarde, who is the head of the ECB, they're sort of now also in that rock and a hard place that they're just not able to, they bring the horse to water, but it's not drinking. And at the same point, they're not leading to anything that's meaningfully changing the dial. And then we haven't even got to the biggest elephant in the room, which is, the UK and Russia deal. We know that also you look at what's going on from goods to services, you look at different parts of the periphery. So you look at Spain, you look at Italy, you look at Portugal. They go like, look, we're doing really well. Yeah, coming from an incredibly low base. You're talking about Spain. So Europe at the moment, everybody's like, it's going to come. Well, Europe's been coming for 20 years.
They made a critical error in regards to going green energy and moving away from.
I think also it's more than that. I think the Eurozone concept has been amazing,
Yeah.
but the catch with it is that you have very, very different and diverse, economies, let alone the fact culturally, although they're trying to say they're all the same, culturally they're different across the whole part. So the other argument is whether or not the whole European Union single market has benefited them as much as they expect. And if you're a smaller country in the EU, there is a big argument to say not. And you then get populism like what's going on in Hungary. You get populism like what's going on in places like Bulgaria and Romania that have come into the zone and gone, oh, hang on a minute, we don't have
the attraction of the powerful euro dollar.
Yeah, and so the dynamism that you keep alluding to, you can't be dynamic if your big brother is a Germany controlling inflation.
Correct. Well, that's right.
Who've expanded.
Your euro gets you buying power in other nations, pretty much around the world, right? The euro is obviously one of the second biggest economy in the world. What was interesting in the inflation data was services inflation accelerated to 5.3 versus 5.4, marking the highest level since April. Energy prices declined, which is a good story for them. They've made also a big decision, and this is what's going to be interesting around their supply of energy from Russia. It's now down to, I think, around 12 to 15% of their energy supply, but they want to eradicate that completely down to zero by 2028. And I know that some of those minor countries in the EU are going to potentially contest that in their courts to see what happens there. But core inflation also is another thing that we want to be focusing in on, right? Which we did say it was held steady at 2.4%, slightly below the forecast of 2.5. So I think those. I mean, you look at the EU's largest economies. Germany, inflation accelerated 2.6, highest since February, above the ECB's 2% target rate. In contrast, Spain slightly eased to 3.1 from 3.2. Netherlands fell from 2 to 2.6 from 3%. Meanwhile, inflation in France, Italy remained well below target. So there is no inflation in France and Italy at the moment at 0.8 and 1.1% respectively. So this, to your point, they're different economies that are summed up into a sum of the parts. Okay, let's have a look at in terms of the policy decision. Rates remained at 2.1%. There are three different policy settings, but in terms of the cash rate sitting at 2.15 for that market. Unemployment, the long-term trend is reasonably good, but we sit here in Australia and we get shivers when we see unemployment rates at 6.4% of our working population. That is certainly, but again, over the long-term trend, that's heading in the right direction. So this is where they would potentially argue that the sum of the parts in running a broader economy has been net positive. That debate continues. In terms of the euro as area around consumer confidence, this is something that continues to play into that political story around, right wing, left wing, centralists, and how they have their identity and what's happening in their own broader economy. So we saw the euro area consumer confidence was a reading at negative 14.2 in November, the highest in 8 months, unchanged from October, in line with those preliminary estimates. But you can still see it's pretty horrible in terms of...
And it hasn't shown any signs of changing. No. That's the catch.
Not anytime soon. And how is that correlating to resale sales more broadly? Well, generally flat. So we haven't seen any sort of positive in the whole calendar, the 4 quarters of the calendar year. We saw negative results in July, and we've seen some movement at the start of the year. But more broadly, we got a net positive overall in terms of the the retail sales. But cash is pretty cheap over there at the moment. You think that would be a little bit higher than it needs to be. And then this is that business confidence story off the back of lots of events. The two main ones, as we know, have obviously been COVID and then obviously the invasion of Russia into Ukraine. And that's really kicked the momentum in those particular markets into this negative territory. So we saw business confidence in the euro area decrease to a reading of negative 6.66 points in November, increasing into the negative territory from negative 0.47. Business confidence in the euro area has averaged basically flat since 1985. So it just gives you some idea that some businesses are doing it tough. Cyclical changes, technology changes, advancements in new products and services.
40 years.
40 years. Yeah, we had a little sniff through the sort of 2015 to 2020, and then another little post-COVID recovery or spring back. But other than that, she's pretty grim in terms of looking at the economic activity over there. Their only shining spot at the moment is the global baby boom world that's all going to Europe and is going to travel there for the next 3 to 5 years as they've been active as part of that story. So that wraps up the Europe story, and it wraps up our the story around Ukraine versus Russia. Is there a deal? What does that deal look like in terms of the impact for the EU? So that's the big talking point that still remains outstanding. Government spending will spike because of obviously they've had to go in and buy more of the US military goods, which is obviously great for the US economy, but they want to ramp up their defence as the US basically makes it clear to NATO that they're not going to play ball in terms of bringing all the big artillery along, and the threat of Russia grows more generally, across Europe. And then energy sourcing and security was the last point we just wanted to highlight.
Yeah.
In terms of, and no different, I suppose, in anywhere else, but certainly from them when they were exposed to Russia, and they've now had to reinvent their energy solution and their energy sources. And so, like any other country in the world, they're looking for cheap, reliable energy, and they want it yesterday. So that's also going to be a problem for the euro area in terms of their cost to manufacture goods and alike. Okay, that brings us to our crystal ball looking into 2026 as we round out this particular update. Finally, the Fed's balance sheet, or their debt position, as what we call our debt, because it's not the government debt, it's our debt, the people's debt. The citizen debt. The citizen's debt is what we're going to be talking about a lot in 2026. And it's now going to be back on the political agenda as Labor moves to its regression to the mean, and the Liberal Party moves to its regression to the mean. And that's the Liberal Party are going to be arguing a base case that they can run a better economy and they can do cheaper taxes, and Labor is going to be there for no one left behind and more spending on health and education and higher debts is what is going to be their particular story. But we also wanted to make sure that we're focusing on what we think are the three biggest things that will move the dial in the country, and that is energy, productivity, and also tax reform. Where is all that gone? So we're hoping that everyone understands that we need to recalibrate our regulation and our government to allow private sector to thrive. We're not going to be a sustainable country if we are thriving off the back of government spending and government debt. As Margaret Thatcher once famously said, and that was along the lines of socialism is good until you run out of other people's money. And so that's an indication of what we obviously need to do, which is get our private sector thriving, get the regulation and red tape out of the way, and let us cook and let aspiring Australians aspire to their lifestyle by design. And with that message, mate, I want to say thank you for a brilliant 8 RBA and economic updates this year. We'll be back again, hopefully next year. All going well. There's lots going on.
We're watching
the press conference here as so Evan's knee deep in all of the latest going on.
Just to finish off, Happy New Year, Mark. Did we consider a rate cut? No, we didn't. Did you discuss a rate hike? Yes, we had a very big discussion about rate hikes. So there we go. Okay, so that's hot off the press in terms of that. So that's the signalling. Yeah, that's the signalling.
We're looking, not jawboning, in terms of, but that's the sort of stuff that we were looking at in terms of that. Yes, so Merry Christmas to everyone. Stay safe. The economic flywheel continues to turn. There'll be a little bit more data that comes out at the end of this year, but we'll be back hopefully again in the new year to talk all things the economy and all things interest rates, and also keep people abreast of the property market through the Property Couch as well. So if you don't subscribe to the Property Couch, make sure you listen on every Thursday. We have a new episode hitting. We're currently in summer series, and of course, like any presentation around financial matters and economy and economics and investing, here is the disclaimer for you all. Hope you all have a Merry Christmas and a Happy New Year. And bye for now, everyone.